Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and we're going to be doing our weekly market update. So much going on. I just wanted to start off with something kind of fun here. So I want to show this to you guys. Trump calls Fed Chief Powell numbskull as he urges interest rate cut, which I think a lot of people are feeling this way right now. And I'm going to get into this. I want to share some of my bullet points with you. The Federal Reserve and White House tensions. The White House aims for a lower dollar, lower energy prices, and a 10-year yield between 3.8 to 4.2. That's kind of the plan. They achieved a multi-year low and falling energy prices despite recent upticks due to Iran-related headlines, which is going to be a big deal for the Fed meeting next week. 10-year yield at 4.3. We'll look at that in real time here in a second. And then the Fed's acceptable range unless labor market issues rise. Fed policy drives 65 to 75% of the 10-year mortgage rate, not federal debt concerns. And the Moody's downgrade really didn't have much of an impact. A lot of people just take that with a grain of salt in reality. But criticism from figures like JD Vance, who called Fed actions malpractice, reflects political pressure for rate cuts. And quite frankly, with good reason. It's high time that we get this lower rate going. And there's a lot of reasons for that. We're seeing, and I'll get into it in more detail as we go along here, but one of them is the inflation report, came down at a lower rate. Right now our inflation's at 2.1%, actually a little lower when you take a look at some of the other data. True inflation's at 1.9%. So, I mean, you've got energy and, prices coming down almost on everything. Sure, the tariffs may have, a short-term impact. There's really not much of an inflation risk unless we see an issue with shortages on certain things, which we're not running into right now. And they just made some China deals, so that's all good. The Fed should not have raised the rates above 4%, really, and they panicked in late 2022 overestimating inflation persistence. So a little history on that. The Fed forecast was for 2023 was a recession that didn't materialize, leading to a policy mismatch as inflation dropped, but labor held strong. That as far as the numbers we had, a lot of that was also downgraded, and we're seeing a lot of issues with the labor market. I've mentioned this before that a lot of what we're running into is people. The Fed's looking at not really inflation as much as they're looking at their policy, which was moving the goalposts, which was unemployment numbers. They want to see higher unemployment. Again, believe it or not, I mention this all the time, but that's their policy. Or Jerome Powell, what he's been saying. Although some of the people are kind of maybe getting off of that a little bit because they see some kinks in the labor market. So we'll have to wait and see what they do. But I mentioned to you last week that the Treasury Department, and again, guys, follow us on YouTube at Mincola Group on YouTube, and all the social media links will be here below, whether you're getting this in our newsletter or you're getting it on social media. Follow us on Facebook, Instagram, so that way you're getting these live updates. I'm even on TikTok, so that way you can stay up to date on what's going on in case you missed the newsletter or you just want up-to-date information daily. You can see what I'm seeing in the data. Again, we're just bringing you the fresh data and what things are showing us. So anyway, that's a little quick thing on that. We're going to see the Treasury again probably do some things over the summer where they're going to get rid of some of the regulations that we don't really need with the banks and having money in reserves, which should lower the rate around 0.5%, give or take a little bit. I figure 30 to 60 basis points, which will be great because what that'll do is affect the 10-year Treasury, which is in line with the mortgage rates, usually around 175 to 2 points, 2 whole points in interest rates on the 10-year Treasury bonds. So that's what we track for mortgage rates, and that split is usually that far. So some Fed presidents like Waller, Bowman have shifted from hawkish to prioritizing labor over inflation, creating internal divisions. Tariff derangement syndrome. We keep hearing, but the tariffs, term coined to describe, overreaction to tariff policy. Tariffs haven't yet, and they didn't in the first Trump term, significantly impact inflation. They could have if there's some supply chain issues, which I don't think we're going to see, but we'll have to, keep an eye on that, of course. But I just don't think we're going to see that. We just made some deals with China. We've got some deals coming with India. So and then we're trying to bring jobs back here to America, which is going to take a few years. Although I heard a really interesting little bit of information on some new technology. It's not really new, but it's newer, and that is, you've heard of printing, where you can print things. Well, now they're looking at using printing for ships, drones, all kinds of stuff. So we can actually leapfrog China in production, and that'll take care of some of those issues with getting ahead of them on those sorts of things. So, anyways, the other thing that I want to show you in this, because this gives us a window into the next 30 to 90 days. Purchase application data. Recent data shows a 20% year-over-year growth, 10% week-to-week growth, driven by easy comparison from last year's declines. 19 straight weeks of positive year-over-year growth, with 6 weeks of double-digit growth. But growth is trend-based, not reflective of a 20% sales increase. So that gives us a window into the next 30 to 90 days on what we can expect. A lot of those are sellers also. So again, you're not going to have the idea of the 2008 that everybody always wants to talk about. You've got about 26. The latest number is 26% of homes that people are buying, or they're buying them with cash, and almost half of the country has a home paid off, and a higher percentage than that. About half the country has at least $300,000 in equity. So, with different lending practices and all that, we're nowhere near the situation that we were in, and we just don't see the weekly data coming in where we have all these homes coming on the market like you did back then, which was 250 to 400,000 homes a week back in the crash. Those homes had nowhere near the equity that we have today. So all that can be dispelled, along with some other things I'm going to get in here in a second. Emphasizes it's important as a leading indicator, though it's often ignored, this whole purchase application data. Shadow Fed president speculation. Rumors about shadow Fed president, which we talked about before, to influence policy. Names like Kevin Warsh, Waller, Michelle Bowman mentioned, though Treasury Secretary Bassett squashed rumors of him taking the role. The White House pushes, and we have to cover these things with what's going on with the government, because, again, we're dealing with things like inflation and policy. So I know a lot of people don't follow, those sorts of things, politically, but you kind of have to in order to really track this stuff on a weekly basis and a daily basis like we do. So we push for lower yield, aligns with historic Fed policy, impacts on mortgage rates. So again, that's lower, yields on the 10-year Treasury, because that tracks with mortgage rates. So future national outlook, second half of 2025 will be critical if inflation stays low. The Fed, which is, we have every indicator that it will, because energy prices are down, along with a lot of these regulations. Fed may face accusations of ideological bias if tariffs drive inflation and soften labor. the Fed could be criticized for lagging. Too slow, Powell, like we always say. So it's going to be a fiery, second half of the year and summer. Again, I would expect by fall we'll probably see a 0.5% dip. But what the Fed does influence the mortgage rates because they influence the bond market by 65 to 75%. So we need to get them moving. Now, one thing I wanted to get into is this Redfin claim. A lot of people have seen this floating around where there's 500,000 extra homes on the market and this and that. Well, it's interesting because if you get into the data on that, let me bring this in here first. Okay. All right. If you get into the data on that, if I can get this to pull up, I guess it's not going to cooperate. Let's see. Fed there. There we go. U.S. housing. Oh, sorry, guys. It's not popping up. Anyway, Redfin's running with these high numbers, this clickbait, and it is clickbait because they're running with these ideas that there's way too much inventory out there. Let me see if I can get it one more time here. There we go. Just not cooperating for me. So the housing market, they're saying that there's nearly 500,000 more sellers than buyers out there. I made some notes on this. Again, you can kind of look at this clickbait if you guys want to follow along with me here. But the chart is seen as misleading. It's designed to generate fear and attention. Not supported by other market data. Market outlook. Housing market remains stable. I think we're going to see about 4% year over year appreciation forecast, equating to a $20,000 gain on a $500,000 home, which is right around the average here in the Phoenix area, I guess, right around now, give or take a little bit. Potential improvement, lower rates could further strengthen the market. Urgent rate cuts needed. The Federal Reserve should cut rates immediately, of course. Current policy restrictive. And the Fed's fund rate. You know what? Let me get to this first. Seller data discrepancy on this Redfin number. I just wanted to show you this first. 1,943,000 million home sellers is what they're saying, and 1.4 million buyers. Okay, the seller data discrepancy comes from basically a methodology that they made up on a ratio. Okay, it doesn't align with other data. Total inventory is 1.4 million with 450,000 under contract, leaving 1 million active listings. Redfin overstates active listings by 900,000 in this case. Buyer data issue, Redfin's 1.4 million buyers, is based on a created ratio, not a measurable metric as admitted in their methodology. If I could get that page to pull up, I could show you that. Let's try it one more time here and see if we can get that up. No, it's not going to cooperate. I guess Redfin doesn't like it, so they don't want that shown out there. Anyway, in their methodology at the bottom of the page on that chart, oh, here we go. There we go. Now I got it. Okay, so down at the bottom, and I've shown this information about their clickbait the last week or two. Down at the bottom, it shows their methodology on this, and it gets into the idea that they're getting, using these ratios and data points and fractions, and it's basically a made-up number. Okay, for clickbait, they're under new management, under new ownership. I get it. You got to get people, you got to get eyes on your stuff, but that's not what we want to do here. So, anyways, the urgent rate cuts are needed. Current policy is very restrictive for the Fed. Fed's fund rate is over 1% above neutral, meaning it's restrictive. Room exists to cut while remaining restrictive. Okay, so basically, neutral for me would be more like, around 3% for their Fed's rate. Okay, so that means we should be in the 4 to 5s if they were neutral. Okay, but right now we should see like President Trump has been saying, and a lot of people have been saying this, they should lower the Fed's fund rate 100 basis points. Okay, that would have a major impact, obviously, on mortgage rates because it would affect the bond market and a 10-year Treasury. So, with that said, let's keep going here. So they're too restrictive. Dual mandate focuses. Fed aims for 2% core inflation, stable prices, and maximum employment. Okay, so low unemployment. They want the unemployment, they're saying, to go up. They want it up, around 323,000 mark for a 4-week moving average, or they want it to hit, around anywhere between 4.3 to 4.5%. So, and right now we're basically at 4.2 and some change. So it's like they're basically, and I showed this in another video I did. Beth Hammock, who's another, and again, that's why you got to follow me on social. I'll try and put it here in our play library for our people following us in our newsletter. But I posted on all our social media already, had her playing and showed the article where basically she's like, it's okay if we're a little late to getting rates down. They're better off thinking that way in their mind than getting ahead of it before we hit an issue with unemployment and a recession, and maybe even, which is a big indicator, residential construction workers losing their jobs and stuff like that, all those indicators. So, not really the greatest policy. You kind of want to get ahead of those things so that we're not running into a recession issue, but that's where they're at. This is what the Fed is saying. Again, check out our YouTube and our social media for that clip, or check down below in the video library here in the newsletter. Inflation tamed. Okay, so we talked about that. The annualized is really about 1.7% below the 2% target. I don't know what the Fed is looking at. They're just insane. Tariff impact, we talked about that, if there's a one-time adjustment or if we have supply chain issues. Labor market weakened, ADP report, 37,000 jobs created. BLS numbers, Bureau of Labor Statistics, higher but often revised down, always pretty much. Unemployment rate is rising slowly, okay, but it's rising, the job market. And again, a lot of people are hanging in there because after COVID, they had to spend all this money for all this training and higher pay to get people back to work. Now they don't want to lose those people. So recession risk, delaying rate cuts could worsen economic conditions, pushing the economy deeper into a potential recession. So there you have it on that front. The next issue that I wanted to show you was Israel-Iran conflict will hang over markets next week, of course, because we know what's going on over there with all the bombing with Israel and Iran, with Fed meeting at hand. So we'll see if that causes any issues with the market, okay? I'm sure there'll be some issues with that. One thing I wanted to point out to you is Fannie Mae consumer housing market sentiment hits 2025 high point. Nearly 30% of consumers say they expect mortgage rates to decrease in the coming year. Okay, again, I think we're going to see a decrease because of what Scott Bessent at the Treasury is going to do with getting rid of some of the regulations from the bank. He mentioned this last October in an interview he did. He mentioned again recently. I think we're going to see that by summer is what he was talking about. So again, that'll be 30 to 60 basis points, just getting rid of those regulations and having that extra reserve money that the banks had to do after the crash. So that's going to be probably going away if they follow through on that. One other cool thing, and I'll get into some of the other data and numbers here in just a second for the Phoenix area. Retro Rate. It's a new startup company, and there's other companies like this already out there, and we already work with them, and we can actually search for a lot of this stuff already on the MLS. But Retro Rate funding round will fuel assumable mortgage tool set. So if you don't know what an assumable mortgage is, in a nutshell, It's basically like you're going back in time. You're buying a house and you're getting that person's interest rate that they already have on that house. So maybe someone who had a 2 or 3% rate during the COVID period, you could actually get that. Now the difference is what you're paying for versus what's left on that loan. So you do need to come to the table with quite a bit of cash, but you can get that balance basically at that lower rate. So again, it's called an assumable mortgage. There's been companies like this out there, but it's kind of a hot topic for the week that people are pointing out. So just wanted to show you that. So if you have any questions on getting a lower rate that way, you can also get lower rates right now with new builders. You can get lower rates actually with us going to bat for you as a buyer. Okay, whether you're selling a home or not, as a buyer, we can help you get a lower rate. Just typically with right now with most sellers and builders offering that what's called a buy down rate. So you could save anywhere from, let's say, on 100 basis point difference, sellers paying concessions or paying for your closing costs, paying for your lender fees to buy down your rate. It's really cool because then that money sits there in your escrow account. So later on when you refinance too, if you ever want to, that money's already there. And it's not only no out-of-pocket costs, but no cost at all probably for your refi. So again, terms, conditions apply. You got to talk to the lender. Everybody's situation's different. Got to put that all in there as a disclaimer. But that's another way we can do that today. Okay, because about over 40% of people right now across the country are paying what are called these concessions to buy down rates and pay for closing costs. So next thing is. Let me get back here. Okay, 10-year Treasury today ended at 4.4. Now, in a normal world, we would be right now no more than 6.4%. But because of where the bond market's already ahead of the Fed, they're already pricing in that lower number, and the Fed hasn't moved. So the Fed meets next week. Will they lower rates or not? The way they're going, probably not this month. But we'll track that, of course, and keep an eye on things. Today, the 30-year fix that when you hear these numbers thrown out, it's always the 30-year fix that you hear typically. And the average right now is 6.9% today. That's the average. Again, if you work with a mortgage broker, one of our lenders, you're going to automatically get a lower rate. If you're on a VA, you can see here, even they're showing a lower rate here, but these are just the averages on these type of loans, FHA, okay, and those sorts of things. So that's where it's at. So right now, I just wanted to kind of point out here that, right now, with these rates, you see 4.4 on the 10-year Treasury. We should be at about a 6.4 at the most historically. There's 175 to 2 point difference, okay, or 1.75 to 2 point difference, and we are right now at 6.8. So again, a big part of that is because the Fed hasn't moved their butts. Again, 65 to 75% of what they do, 65 to 75% of what they do will affect the bond market, even though the bond market is typically ahead of the Fed. Okay. All right. Now, this is what we call the, actually, before I get into that, sorry guys. Let me just show you some of the other numbers here in the Metro Phoenix area. We've got right now 87 days closed on market, 5.32 month supply. What does that mean in layman's terms? Well, right now, if we weren't to sell any or no more homes came on the market, and we actually had a small dip, you'll see here in active listings this week. Pendings and closings actually went up. So we're seeing buyers again with that purchase application data getting back into the market. Okay. And the if there weren't any new listings, we would have a little over 5 months supply. A balanced market for me, again, we can get into the history of the balanced market, but a balanced market for me is about 3-4 months. Okay, so right now we're really more in a buyer's market, which we'll talk about here in a second. Absorption rate, that's a little low. Okay, we usually like to see that a little bit higher. What's being absorbed in the market, that's why these numbers are so high. Okay, and the average list price $763, and the average sales price is $614. The list to sales price ratio is 96.86%. So typically, that's lower than 100% of the list price to sales price, obviously, and we usually like to see that number right above, just above 98. Okay, so again, sellers are, and builders are having to lower prices. They're having to give concessions, so that all plays into that list to sales price ratio. Okay, and then as far as our distressed properties, really nothing huge there. Short sales, lender owned, HUD, nothing crazy. Those numbers actually have dipped down in the negatives there. But again, we do see the pending and closings up, so that's encouraging. And we can see how this breaks down in order of prices down here in the bottom left, and the units that are available, days on market for each one of these categories of pricing ranges, and what the changes are there. So really interesting stuff, kind of aligns with what we're talking about really when we say that, we've got a little bit lower number in listings, and we're looking at the supply and demand side of things. So let me see if I can make this a little different for you here so I fit in here a little bit better. Okay, maybe not. Let's see. Oh, no, that's not going to help. Okay. Anyway, right now we've got supply and demand. Supply is actually down a little bit, and which again, what we've been talking about, demand is up a hair, and our Cromford Market Index overall is at 72, which below 90 is a buyer's market. So we're in a buyer's market overall across the metro area, and over 110 is a seller's market. So when we look at that, we want to make sure we understand that if we were actually these two numbers were the same, it would actually, be right in line with a balanced market if supply and demand were the same, but they're not. So as far as the contract ratio is concerned, we're right in this balance range of 30 to 60 or colder in some areas. So we're not really seeing anywhere where it's a super, heated up market for sellers. And as far as the contract ratio itself, we're at 32.1. Okay. So that means, here we have, a hot market for sellers. So we're at 30, we're at half that right now. So that kind of shows the active to the number under contract, which is much lower. Back when we had the crazy market, we had, really, really crazy nutty numbers, which I can't really get on here right now, but anyways, without it jumping around. But that gives us an idea of what's going on in the market here, guys. If you guys have any questions, would like to reach out to me with anything, I'd be happy to help with any questions you might have, on what's going on in the current market, and what we can do to help you with your purchase or your sale of your home.